Thursday, March 21st, 2019, Maneco 64, home of alternative economics and contrarian views. So the Federal Reserve caved in yesterday. They said they will not raise rates at all in 2019 and that they will stop doing QT or rolling off their balance sheet by September this year, and that they're going to decrease the amounts that they do from May. So their balance sheet is going to get roughly to around 3.9 trillion from 4.4 trillion. So much for watching paint dry. You all know, those of you who have been following for years, that I'm a big critic of the Federal Reserve. I think the Federal Reserve and central banks in general should be abolished. It's anti-free market. Central banking, of course, is one of the planks of the Communist Manifesto. So we don't need it in a free market, free society with small government. We don't need central banking, and that's my gripe with central banking. Before I go into the Federal Reserve and what they did, and the subject of inflation and what I really think inflation as it's defined today is, I'll look at what the markets are doing this morning. So here we are. It's just before 8 a.m. London time. We've got spot gold at 1318.75. So it's up just over $6. The high has been 1320.50 and the low 1312. So, of course, gold did well yesterday prior to the FOMC announcement. It was trading just above 1,300. Silver, 1560, up 12. The range has been 1543 to 1565. Silver outperforming percentage-wise gold here. So, the stock market, you would have thought that with the Fed caving in, that stocks would have rallied, but they haven't. I mean, yesterday the Dow dropped 141 or 0.5%. S&P dropped just under 1/3%. The Nasdaq was up slightly, 5 points. This morning we've got here Dow futures down 131 or 0.5% lower. S&P 500 down 8.25 or 1/3 at 28.15. And the NASDAQ 100 future is down 10 or 0.14% at 73.70. So interesting that the stock market hasn't been able to rally. Maybe it's because investors are realizing we're going into a recession, and I come to that in a minute looking at the yield curve. So we've got the pound down 17 at 131.79. The high's been 132.20 and the low 131.76, so right near the low. The euro is fairly steady. It's 114.12. Dollar index did come off yesterday quite a lot. I've seen that we've got like a quadruple top in the long term in the dollar index, just below 97. I think now we're just below 95. The dollar is down almost 1/3% against the yen at 110.38. Dollar dropped quite a bit against the yuan yesterday. We're now at 668.50. I think yesterday when I did my video it was at 671. Crude oil also continuing higher. It's above 60 now, WTI, so we've been noticing that it's creeping up. It's down on the day here, but trading at 60.09. Brent, it's at 68.30, unchanged. What about the yield curve? That's the most interesting, one of the interesting events that happened, that took place yesterday. The yield curve, the 10-year dropped massively. We're now at 251. The 10-year yield. Yesterday it dropped from like 261 to 253 or thereabouts. And now the 6-month T-bill is at 248. The 7-year is at 241. So minus 7 basis points inverted. And it's only a matter of time, I think, for the 10-year to be below the 6-month T-bill. And then that's not a great signal at all. It's a signal of a recession, an inverted yield curve. It started out like 1 year to 3 year and 5 year, and now it's spreading all throughout the yield curve. That's not a good sign. So what is the Fed saying? I saved an article from Bloomberg because Bloomberg is very mainstream. They parrot everything that the central bankers say. They don't criticize them. So their headline yesterday was Powell signals prolonged Fed pause as inflation lags. Risks loom. I mean, I've spoken about this before, how they've corrupted the definition of things. And I always do this little exercise with this old Merriam-Webster pocket dictionary. This is from the 70s. I'm not sure exactly what year, but they've even got the census from 1970. So I would say it's somewhere between 1970 and 1980 because they didn't have the population of the United States. They only had the 1970 census, and I think the census, of course, is done every 10 years. So at the time of, and it's interesting how they used to summarize by state and dependency. So the population of total United States and dependencies population, 206,206,000. So it's an old dictionary. So I want to look at the definition of inflation here from the Merriam-Webster dictionary. So it says, an abnormal increase in the volume of money and credit resulting in a substantial and continuous rise in the general price level. So that was in the 70s, how they defined it. Today, Merriam-Webster dictionary says a continued rise in the price of goods and services. So they don't even mention money and credit. So that's why the Federal Reserve gets away with saying that inflation lags, because as we all know, and I highly recommend people go to shadowstats.com. They look at how CPI, which is now called inflation, and shouldn't be, but it is. They look at how it used to be calculated in the 1980s and in the 1990s. According to them, the 1980s calculation, CPI would be just under 10%. 1990s calculation, CPI would be around 5%. So, and the Fed now is worried that CPI is below 2%, and they need to keep it at 2%. And even that is kind of, how can I say, doesn't make sense, because we all want actually lower prices all the time, but the Fed is saying that we need to have 2% debasement of the currency every year, and that's a good thing. The only reason they say that's a good thing is because it's a fiat money debt-based system. So if the debt doesn't keep growing, the whole system implodes, and that's what it's all about. I mean, how come just a few months ago we had the stock market at was all-time highs, the economy was doing great, unemployment was at the lowest in 50 years, and now all of a sudden they can't even raise rates anymore. I mean, back in the 80s and 90s, if we had the stock market at such lofty levels as it is right now, unemployment at these levels, interest rates would be 6-7%. Excuse me. Now they can't even get just above 3% as per the 10-year, and they panic. So this is just showing that what the Federal Reserve is worried about is not inflation or the cost of living for the general public, but it's worried for the 1%, the top tier of the people who own the financial assets, the big banks, the big corporations. That's what the Fed is worried about. The Fed is not concerned. It doesn't work in the interest of the American public. So the other thing I wanted to look at is the Big Mac Index. So what's the Big Mac Index? Some of you might know. So I'll read here from Wikipedia. And the Big Mac Index, in my opinion, doesn't lie. The Big Mac Index is published by The Economist as an informal way of measuring purchasing power parity between two currencies. So that's what it's used for, but it can also be used to compare purchasing power of that currency over the years. And if you look here further down in Wikipedia, it says in July 2008, the price of the Big Mac was $3.57 in the United States. Of course, it varied between different stores, but I guess on average it was $3.57. And now you go to this website here, statista.com, and you've got in January of 2019, the Big Mac is $5.58. So I calculated that over 10 years, let's say July 2018, that was up 56%, the Big Mac. So that to me tells me that the purchasing power of the dollar in terms of Big Mac went down by 56%. If you annualize that, that's about 4.25 rises. You know, that's maybe more what the CPI should be. That's what I would say the real inflation is, at least 4.25 as per the Big Mac. Of course, John Williams of Shadow Stats sees it even higher. So for the Fed to say that they are concerned about low inflation is just rubbish. I think what they're concerned, of course, is about the stock market, the corporate bond market, their credit bubble. That's what they're worried about. And they're worried about their, the people who own the Federal Reserve, the bankers, the big corporations. They're the ones who have the most to lose of this everything bubble we've had since 2008. The public is already losing in the higher cost of living. I don't live in the States, so maybe you guys can tell me in the comment section how you've noticed things going up over the years. I can tell you in the UK, they use the same excuse, the Bank of England. I even saw a paper in the BIS website because I was looking at this Basel III thing. I saw a paper from the Bank of England economist saying how to beat deflation, because there's danger of deflation. But I can tell you the price of everyday goods, utilities, all the things that you need to survive, tuition for universities. I guess the NHS is free, supposedly free here, but the quality is going down. We've got shrinkflation. And I bet it's the same in the US. Everything is, going up. As I tell a lot of people, they say, oh, the price of this is going up. I said, no, the pound is going down. So, Federal Reserve, of course, in my book, they have no credibility. But right now, I think they've lost face, with this complete turnaround yesterday. And that's why precious metals are moving higher. And how long will they be able to keep this lie? And I have to say it's a lie about inflation and the cost of living. Cost of living is going through the roof. Of course, the 1% or the billionaires, they don't care, if something goes up a little bit, something in the shop like milk or bread, because it's something they don't notice. But the great majority of the public earn as much, they feel it. So I highly recommend you guys go to shadowstats.com, have a look at the Big Mac Index as well. If you enjoyed this video, make sure you hit the like button. If you enjoy my videos but haven't subscribed, think about subscribing. Also make sure you hit the little notification bell to be notified of my videos. And make sure you share my videos with people who you think might enjoy it. You can also follow me on Twitter, Steemit, and DTube. I wish you all a great day. Take care. Bye.